As the government hints at changes to negative gearing, it is crucial to understand how these potential shifts will affect both investors and renters across the property market. For more, let's bring in Gianni Musumeci from Leverage Property Advisors. Gianni, what potential changes to negative gearing are actually now being discussed?
Well, it's been proposed that the government are looking at limiting the number of houses that you can negative gear upon or count towards your negative gearing cap, which for some investors or the small minority of investors that hold 2 or more investment properties, they might be limited in terms of the amount that they can claim back at tax time.
It's a pretty scary time for a lot of investors out there who thought they were doing the right thing, following the laws, and now the idea that the rules could change. So how could these changes impact property investors?
Well, essentially the negative gearing helps with some of the losses that property investors are making by reducing those losses and being able to claim back some of the tax at tax time to support their investment property. However, if they are no longer receiving that support in the form of tax deduction through negative gearing, then they may be forced to pass on those costs to the tenants as a result.
Yeah, so obviously investors are worried now, but what, I guess, effects could they face in the long term?
Yeah, look, long term, as a result of these increasing costs, it may no longer be feasible to hold on to these investments for the long term, and investors may be a little bit cautious around entering the market, particularly because they're not going to receive the support in the form of tax deductions. And as a result, what will happen is there'll be less investment into the property market and therefore less rental properties made available. So in future, those investors that aren't going to receive that support to hold on to the investment property over the long term, or the incentive rather to hold on to the investment property for the long term, they may forego going into the market altogether, which again then will reduce the number of rental properties being available. And especially now being in a supply crunch as well, we need more rental properties made available for tenants.
It's pretty grim, isn't it, Gianni, when you think about it, because we've been talking for the past few years, ever since COVID, about the lack of properties, and then the huge number of migrants, obviously, to Australia has caused an issue there as well, or at least been part of it too. Just as government, state and federal are promising to be fixing things, as you say, the impact, maybe intended or unintended consequence of these changes will mean that the effect will be fewer rental properties available.
Yeah, and we don't really see too much incentive in the form of supply being added to the market, especially with the low deposit scheme and the influx of migration that we've had over the last few years. We're finding that more and more demand is being placed on the property market, especially from an owner-occupied perspective, which dwarfs in comparison the number of investors that are trying to get into the market. So those two initiatives combined with the low deposit scheme and investors trying to get into the market is placing a huge amount of demand on an already tight supply market as well. So in terms of the near future, it's going to be harder and harder to get into property, and with the number of RBA rate rises that are forecast over the next year or so, it's going to become more expensive as well.
So what, I guess, then are your, if you were to have a crystal ball, what do you envisage will happen to the rental market in Australia?
Well, the rental market the average rental price will either go up or it'll be harder and harder to find a property, because between interest rate rises and the removal of negative gearing in some form will actually make it more costly to buy an investment property. So rental prices will no doubt go up. It'll be harder to find a rental property to rent out as a tenant, and then there'll be even more vacancies as well. And then we'll probably find that owner-occupiers will have a little bit more supply to get into the market, but with the interest rates forecast to rise over the next 12 months, especially with inflation up and the war that's occurring at the moment, no doubt that's going to put pressure on the RBA to raise interest rates and then make it more expensive to buy a property again.
You make a really interesting point there about everything going on in the world. So what are, I guess, your insights on the outlook for the overall property market?
Well, a lot of the economists that I listen to, they are almost certain of a rate rise. At the moment, the percentage chance of a rate rise is roughly 33%. but there's a lot of economists that are certainly tipping one, if not two, rate rises this year as a result of what's happening in the world. Inflation, the cost of oil going up, and therefore, again, it's going to be more expensive to take out a loan. So we might see that loan approval rates are starting to drop off, or that the average amount for a loan approval is reducing as a result.
And Gianni, if people want to find out more from you, where can they go?
I'm across all social media handles at Leverage Property Advisors, or you can reach out to me on my website, leveragepropertyadvisors.com.au.
Wonderful. Appreciate your insights on Ticker as always. Thank you.
Thank you so much.